So welcome to GAIM. Alasdair, you're heading the investment strategy
That's
for
right.
Towers One Summit. Tell us a bit more about what's the mood today. There's a lot of questions. We're at GAIM. There's a lot of uncertainties in the euros and so on. What's the mood with your investors? How do they feel about the current situation?
I think we picked a great day for the first day of the conference, because we've obviously had the Greek election results this morning, which maybe are slightly more positive than people expected. But the overall backdrop, as our first presenter, Jamie from Lombard Street, pointed out, is one of it's low growth, it's high risk, it's a fairly depressing world out there. There are a lot of unknown unknowns, in Mr. Rumsfeld's favourite expression. To be honest, I don't think any of the presenters today are going to have an answer to that. We just need to recognise that when we build our investment policies and build something that is, like a nuclear power station, fail-safe, because we know there are some bad things that can happen out there, and we have to make sure that doesn't kill our investing institution.
So this point is very interesting, because in your panel, one investor mentioned that he's really looking to have mostly exposure in sterling, doesn't know exactly where euros is going. Well, you have a different perspective there. Can you tell us a bit more?
Yes, I think it's very difficult these days in a globally integrated economy to actually avoid exposure to the Eurozone, because even if you buy purely sterling assets, so UK equities, most of their profits come from abroad, and a lot of those profits actually come from the Eurozone. And even if you buy a purely domestic US company, a big crisis in the Eurozone, a breakup in the Eurozone, is going to have quite a traumatic effect for global demand and global markets. So think Lehman Brothers on steroids. So even that purely domestic Midwest US company is going to have a knock-on impact. It might not be as significant as a Greek company, which will clearly be potentially wiped out by the crisis, but you still will see an impact. So it's very difficult, I think, to hide from the Eurozone crisis. And to the extent there are sensible things you can do, a lot of investors have already done that.
Okay.
So market prices have moved. Markets are broadly efficient. European assets are cheaper, but they're riskier. That feels like, feels like the way it should be.
It should be, okay. And you also said that you're more advising on a sort of long-term perspective, and in that perspective, again, it makes sense to have that sort of
That's correct. It's quite if you're taking a 3-year, 5-year view, to say I won't hold any European assets is equally risky as holding lots of European assets, because for all we know on that kind of time horizon,
definitely
the policymakers could take the right actions.
Yeah.
As we recognised this morning, they have all the tools in their toolbox that they need to solve the problem.
Yeah.
If they do that, we'll see a big rally in European assets. We're seeing a rally already in equity markets this morning, just on the kind of a slightly better than expected election results. So if you don't hold European assets, you miss out on that. What you can do, though, is try and employ managers who operate over that shorter timescale and can maybe manage this risk-on, risk-off process to add value. But that's a difficult game.
And in terms of currency hedging as well, you can also try to really hedge what you would perceive as a big risk.
That's correct. You certainly would want to think about your currency hedging program. Don't take unnecessary euro exposure. But it's not as... Who are you going to buy the Eurozone hedges from? European banks. If the euro breaks up, what's going to happen to that bank? Are they necessarily going to pay out on the hedge? You're certainly going to be better off for having hedged, but you won't necessarily be potentially made whole, so you won't necessarily be fully covered, as you rightly say.
All right. In terms of, you mentioned risk on, risk off. Do you see some sort of trends there? What's, again, the mood from investors' perspective?
I think the trend, as it were, is that there is no trend, and just around that we are seeing this risk on, risk off. If you look at both equity and bond markets over the last year or so, since August 2011, they've very much range traded, and so the only way, which doesn't give you great returns, if the capital value isn't going anywhere, then you're just banking your equity dividend yield of 3 or 4%, which is not up there with people's return targets. They need more than that. The only way to try and get more is buying on the bottom and selling at the top to try and boost returns, and so a lot of investors are trying to manage that cycle. But by definition, they can't all succeed.
Succeed, yeah, definitely. So as you see, a lot of questions, potential answers. Attending a GAIM conference is very interesting to see that different perspectives between the continental view and as well the UK view. Thank you.
Thank you.